I don't like to make big year-end predictions, although I do make them on occasion. Last year, my big call was going to be Facebook was going to get to 100 plus. That happened, and I'm happy that it did. I know it helped a lot of people. I know a lot of you guys who follow me caught that move. It made us all some pretty nice coin in an otherwise flat and dull year. One of my predictions was also that we were going to actually have a flat year, that we were going to have a big sell-off and then struggle all year to come back to be flat, and that kind of happened. So the problem I have here with 2016 is that I believe we're on the wrong side of a policy error in the Fed. I had talked about the Fed needing to stay lower for longer. If you're new to me, lower for longer just means that they need to keep the ZIRP or the zero interest rate or low interest rate policy for an extended period of time. So over the summer, there was a leak of Fed staffers that basically plotted out their trajectory for raising interest rates. And I had been talking about in multiple articles before then and in multiple posts that I didn't expect the Fed to normalize to the normal 5 to 6%. I expected them to normalize to about 3.5%. And that is actually the number that they have highlighted that they're targeting, basically 3.5%, which is great. The problem is they have been in, I guess they've been signaling to the markets that they want to hike rates, and they had their first hike obviously in December. The problem is that their forecasts have been wrong, big time. Their forecasts on inflation have been wrong. Their forecasts on global growth have been wrong. Their forecasts on global economies have been wrong. Their forecasts on commodities have been wrong. The list goes on. It's a litany of horrors. Actually, this is sort of starting to set up for the perfect storm for exactly the opposite of potentially, and I've mentioned this, that I said if the Fed raised prematurely, a recession. What does that mean? It means that the market would have to go probably a lot lower. And I'll explain to you how I come up to that. I see two likely scenarios for the market this year. We've had 2 years of consolidation. First of all, I think that a lot of 2014 and 2015 were kind of the hangover from the 30% run-up of 2013. And we never really retested the breakouts of the 2000 and 2007 peaks. And we have just been kind of, I guess, bull flagging to the side, although it's been a little bit iffy at times. It's looked a little precarious. I haven't really liked the markets in general, with a few exceptions like the Facebooks and the Netflixes and the FANG type of stocks. I'm gonna explain to you why I'm cautious. Let's go through the Fed keys, the sixth and the seventh one, and I think someone had posted, a guy I follow on Twitter had posted his estimates here. Wow, that's bright. For global growth in 2016, and I think you'll see why I'm cautious. So the Fed looks at these 6 keys. They look at the non-farm payroll, that's the jobs number, which they keep saying is good and improving, but the problem is that it's not good. We have the lowest labor participation rate since 1978. That means the percentage of Americans in jobs is bad. And if you factor in the unemployed, and I think the structurally unemployed, think about technology. Toys R Us's are closing. You have a lot of retail is not doing well. It's all a move to online and automation. Like, that's why Amazon is doing so well. Things are all getting technological advances, and it's causing people to lose their jobs. I don't get commercial breaks, so I have to drink some water on air. Sorry. So that's a problem. The structural unemployment. So the jobs numbers I don't think are good. So that's one. GDP, and I'm going to go through this litany of GDP estimates here, but let's start with the United States. We know that the last 2 years we've had catastrophically slow first quarters that have been stall speed to negative or just barely eking over the finish line of positive. So The Atlanta Fed was only estimating, they had originally been at like 2.1, then it was 1.9, then they lowered it to 1.4, now it's back up to 1.9. That is really weak growth. And I'll tell you, I'm just going through the estimates for 2016. Just listen to this for GDP. The US is only 2.5%, China is 6.4%, Japan is 1%, the UK is 2.2%, Canada is 2%, France 1.3%, Germany 1.7%, Russia negative 0.3%, India 7.6%, and Turkey 3%. These are developed economies, and they're all teetering, with the exception of China, of course, and India. Those are growth economies, but they're slowing nonetheless. And it wouldn't take a lot in terms of terrorism or natural disaster or just an economic slowdown to cause these growth rates to go negative. That's how if you get 2 quarters back to back of negative growth, and we know the first quarter is slow, you're setting the table for a potential recession, and we're already kind of having a bit of a top-line earnings growth recession as it is here. Yes, I said growth in Russia was supposed to be negative 0.3%. ISM, that was negative. That first came out that the industrial one was negative, and then the TV talking heads were saying, we're not really a manufacturing economy anymore. We're a service economy. And then the service the service ISM came out negative, and they didn't have much to say on that. PMI was negative, all below the 50 number. I mean, very much below in some instances. We just had a read today in terms of growth. It was not good. The Fed has been citing the autos and housing as, in terms of durable goods. They've been talking about, that being a point of strength. But the problem is that autos and housing are very dependent on interest rates. And if interest rates start rising, those will go in the tank also. It's sort of like we're on a 747 being the economy, and one by one the engines are flaming out. If you have 4 engines and one engine goes out, you don't like it, but you're not really that concerned. A second engine goes out, you start getting a little more concerned, and then the third one goes out, and you have one engine. You're like, hey, let's get landed already here. So that's really a big concern of mine. That the durable goods numbers, besides autos and planes, and if you want to lump housing in there, have not been good. The dollar has been a big factor in American goods not being as competitive. It's been dangerously strong. We have backed off a lot the last couple of weeks. Since the Fed decision, actually, it got a little bit over 100 and then backed off. We've been making some lower highs and I guess now some higher lows here. What I've been looking at is the UUP. I drew in some bars there, and above 25.68 is bearish, meaning bearish for the market, bullish for the dollar. And we stopped a little bit just besides there today. We actually broke the downtrend. We closed above the 50, and we stalled just below there. So this is going to be very important next week. If you start getting a dollar rally, that's not going to be good for the market. Conversely, on the bottom side, 24.47 is the lower end of that range. Anything below there is bearish for the dollar, but bullish for the stock market. So just keep those numbers in mind. I'm very concerned about the dollar. That could be a really big problem going forward. And we've seen the havoc that has wreaked on commodities, including oil, which I will get to in a minute. The seventh Fed key that they don't discuss, and I think the reason they felt covered that they could raise interest rates, is the S&P 500. The S&P, at the time they raised rates, was basically near all-time highs. It had recovered from the flash crash lows quite well, and I think the Fed felt that they were able to use that for some cover. So that is those are the 6 Fed keys that they look at. And the reason I believe, like I said, I think that there's a policy error is that the Fed needs to hike interest rates for 2 reasons. One, if there's an inflation problem, and we sure know that there's not, with crashing oil, crashing copper, crashing grains, crashing gold, crashing everything that has anything that's tied to a dollar amount. We know the dollar is going up, and demand for these commodities has fallen off of a cliff. So that is that's the story with that. We also know that the other reason would be a raging economy, and if you consider struggling to keep 2% growth a raging economy, you need a straitjacket. So that's a really big problem. I'll tell you this: for a while, I had been saying that high energy prices had been this could be the one saving grace, and that this should correct things. In the short term, it's a negative. Lower energy prices directly affect GDP, so that is a drag the minute that it goes down. The saving grace, though, is that European and Asian economies who aren't really natural gas or oil rich have been struggling for growth with weak economies and weak unemployment. And the high price of energy up until recently has been a huge drag on their economy. The good news is that energy prices have come way down, and the cure for high price, I always say the cure for high prices are high prices, and the cure for low prices are low prices. Meaning, at some point, some prices get too high, and people won't pay, and then price comes down. And also at the bottom, when prices get too low, everyone starts getting interested, and the price becomes unsustainable, and they come back up. So that is my story with that. Short term, the energy price has been a problem. Longer term, that will be good. The problem that you face is short term. You have You've had a lot of these bond funds like the JNK and the HYG. They're all piled into these these high yield debt from oil companies that were basing, their debt payments and their dividends based on, $70 oil, and we're struggling now to hold on to $37 oil. So I think that these companies below 40, 45, 50 are, they're struggling, and that immediate impact is hurting our markets via the bonds, via these stocks. A lot of hedge funds, a lot of funds that have chased yield. What happens when interest rates are lower for longer? The Fed had encouraged people basically to jump into risk assets, and people who were accustomed to putting money in CDs and in bonds put their money into these MLPs and into these high yield instruments, not really realizing what they were buying. And I think that they've gotten their heads handed to them, and that's been part of the problem. So the immediate effect of down oil hurts oil prices. There's a large percentage of the S&P 500 that is, the Chevrons, the Exxons. There are many other companies, BPs, that are all oil plays. And as oil has gone lower, it has hurt that sector. If that can turn, then I think that could be a net positive for the market. But obviously we haven't seen that net turn yet. So what that has resulted in is algorithms, the machines, I always call them the terminators. They are programmed to key off of various things at any given point in time, and they have been keenly keyed into oil the last few weeks and months. And that when you see upticks in oil, the market rallies, and when you see downticks in oil, the market declines. So that is what the market has been keying off of. My big call and my big fear for 2016 is that the algos will move on from oil and they will get keyed into yields, bond prices. I have said that this right now is just a concern, which it is. It isn't a manifest reality yet, because the levels that I'm looking at for that to become a problem, the danger zone, we are not there yet. But I will say this. If that happens, the market could be in for some really rough sledding, so to speak. The 2009 crash peak in TLT was 123.15. And as long as we're below that, the great bond market rally is in jeopardy. The bond market doesn't necessarily need to rally for us to be okay with yields. They just need to kind of stay where they are. I've been saying that the 117, 118 is sort of a fulcrum pivot. If we lose those lows, we're contending with the 114.88, 115, 114, 115. And if we lose that area, I would say that we are in to the deep end of the pool in terms of yields rising, and there will be trouble. If we can get back up above 123.15 and hold there, then I think things are kind of more hunky-dory in the yield in that situation. And if we do start getting into the recessionary stride, I would expect those yields to drop, meaning bonds would rally. So it's going to be a little bit of a ballet dance here. We're going to have to see how that goes. So just keep an eye on that. Like I said, those fulcrum pivots of the 117, 118. As long as bonds are north of there, things are kind of okay. If being a little suspect that we're below 123.15. If we start losing the 114, 115 area, we have Houston. We have a problem. So that is the area, the danger zones that I see, and I want you guys to be very careful with looking at. Let's see. Let's go into some of the stocks you guys want to talk about, because I want to wrap a little bit quickly today, just because it's the holiday and I know people are anxious to get to their New Year's celebrations. So let's just go through them in the order in which they've been received. So the first one was Nike. All right, so Nike, I think that Nike was sort of a little bit of a victim of its own success. That was a stock that had a lot of gains on the year. There weren't that many. There were really just a handful. If you weren't like in FANG and Microsoft and Nike and Disney early, you didn't really have a lot of, and McDonald's, of course, there weren't a lot of gains. So Nike had been stellar. They had a good earnings report, and I think funds just used that volume to sell into. There had been a 3-for-1 split in Skechers, and then after that it had like a 30% decline. So Wall Street is always fighting the last battle, and I think they were just a little bit nervous about that, and it was just some profit taking. There is some room still for a further downside in Nike. I would be interested in buying this if it could get to like the low 50s maybe. I would start getting interested, maybe the high 40s to low 50s again. We'll see. There's a gap fill in Nike somewhere around 57.40. So if you take the flash crash low, you put a Fibonacci on that, the gap fill, the 50% is 57.67, and then 55s are the 61.8. I would start getting interested in some type of a write out play there to maybe sell some puts. Twitter. So the deal with Twitter is this. I talked about a few CEOs, by the way, being the worst CEOs of 2015, and I hate to say it, but Jack Dorsey made the list. Those CEOs, by the way, were Mark Ellis from Lynn Energy. His stock's in the dollar range. That's pretty bad. Rich Kinder from KMI was pretty bad. You know, we all know that they had promised dividend growth, and the stock got really pretty badly binged up, and they now cut the dividend by 75%. Nick Woodman from GoPro, who is, I think, a complete disgrace. You know, this guy prematurely unlocked shares after the GoPro IPO, and the stock has really been a disaster ever since. Jack Dorsey from Twitter. I think that they cocked around a lot while he was the interim CEO. They took a long time keeping Costello on. He, came in looking radicalized with that crazy beard, and now he's hiring diversity directors. I mean, how crazy is that? You're hiring a diversity director when your stock has been more than cut in half and you can't get your MAUs up. I mean, focus on shareholder. Shareholder value, getting some money back to your shareholders and growing your business, not, getting the guitar in the break room and singing Kumbaya and everyone feels good about themselves. I'm so tired of this politically correct bullshit. I mean, I'm sorry, it just pisses me off to see, I know a lot of people are involved in Twitter. I get really angry when I see companies mismanage themselves, and it really pisses me off when I see a CEO making stupid mistakes that are so blatantly obvious. I mean, this guy is just out to lunch, and he better get his act together, or this stock is going to get cut in half again in 2016. I could just see it now. The stock is going to be $9 if they muff it again. So The story is with Twitter is it's going to be a binary trade. It's either going to be $9 or it's going back to 45, 46. That is really how it's going to play out, in my opinion, and I've been really right about this stock for a while. Yeah, exactly. Twitter's down 57%, this gentleman just said, since April. I mean, this is just complete incompetence, and they're hiring diversity directors. I just want to explode hearing something like that. So anyway, the stock today performed pretty well. You probably had a lot of tax law. It's completely insane. This is like just ridiculousness. So the stock is unfortunately looking a little head and shoulders-ish down here, believe it or not. Still in a downtrend. It did have a good day today. It seems like it's trying to rally a little bit. I actually would prefer it doesn't rally ahead of the quarter, although it's probably going to. It's better if it's weak or just stays stagnant for a while, build a little bit of a base down here. I'll tell you, below 24.34 is a little bit vulnerable. It's really got to stay above 21.01. That was the low. And I don't like that it had a day like this similarly where it kind of had a look below and fail and then went back up, and that low was 23.54. So we're kind of close to there. We closed a little bit below there. I would be. I'm just really cautious in this stock. I've said it for a while. What really matters for them is they need 2 back-to-back solid quarters where they can show growth. That's when Facebook turned around. A lot of people don't know this. Everyone knows me with the Facebook call to 100, but the truth is if you really go back to my stream, I hated Facebook when they first IPO'd. I told all of my friends on Facebook and even on Twitter to just stay away from it, and I didn't turn bullish on the stock until it was $20. It got to 19. I had a big controversy on the stream. There was a friend of mine who said she thought it was going to go to 16, and I said no, I think it's done. And I never looked back. I got bullish at 20, and I never looked back, and we all know what happened. I made the 100 call. I was lambasted for that call. I was told I was an idiot, a dope. I said 100, 103, and 109 was really what I was looking for. I don't want to go over those calls, the reasons for those levels. There was channel reasons, and there was just Fibonacci extension reasons. And it wound up being correct. But a lot of people don't remember is that it took 2 quarters back-to-back for Facebook to show that they had conquered. The Facebook problem was they were transitioning from web-based advertising to mobile-based advertising and mobile-based user growth. And Zuckerberg did a great job, and it took him 2 quarters. So that's really what Twitter, I don't even know. They might need 10 good quarters after the way they've messed up. But the truth is they really need 2 good quarters. And I think if Jack Dorsey, I think he's a really smart guy. I might have been a little hard on him with regard to how he's managing the company, but I do think he's a smart guy, and I do think he can turn it around. The question is, will he? And hiring diversity directors is not the way to do it. That is just BS, and he needs to focus on monthly average user growth. Yeah, they have 300 million users or whatever, but they've stalled out. And the problem is that Twitter is an expensive stock. I forget what the market cap is. I think it was 12 billion or whatever it is. And that's a lot. The sweet spot for stocks to be acquired are 2 billion. And we'll talk about that in a little bit, but 12 is a lot. I think that I have to relook what the market cap is, but it's still an expensive stock. It's still a huge multiple, and they are priced for growth, and they don't have it, and they need to reclaim it. Anyway, I spent enough time on Twitter here. As you can see, I'm a little bit impassioned about that. It upsets me to see that type of management do those types of things. Amazon was the next one. So the deal with Amazon the stock has been up so much. It had this sort of blow off top. I think there were a lot of people who were looking for a move to 700. I would say you basically got the move. 684.82, there had been a really big consolidation with 660.64 being the low end of that range. You had to look below and fail, and now you've had to look above and fail, and now you're almost back to mid-range. So the reason why I think you had to look above and fail was the 2 days that took you out of range. I don't think people realize this, but 4 days ago, the stock, before the rally, the stock in pre-market had been $30 lower or more than where it topped out. In 2 days it made that move, and I think there were just a lot of people who wanted to lock in the quarter and lock in the end of year and their gains, and they got kind of close enough for government work. I would say yesterday the price action was fairly bullish. It was able to hold 684.82, and then today, once you broke that low a day, it was just, a rush for the exits. I'm not sure that Amazon is done, but for all intents and purposes, we're going to know next week. The FANG stocks were run up huge this year, and I think a lot of people were waiting to sell them for tax purposes, so we should know in the first couple of weeks how these stocks trade. The problem has been, and one of the questions I was asked on Benzinga, and I've been talking about for a while, is the narrowness of the breadth of the market. Like, if you're not in like a handful of stocks, you're probably in stocks that are getting murdered. So if the FANG stocks roll over, and these are big market cap for the Qs, the NASDAQ, the Qs, that's really been what's holding up the market. Apple was weak today. I've said below 109, 110, and it failed the other day again. That 107 was really the must hold. We're below there. We were barely holding on to 105 today. Below there, it's 103 and 100. 103 being 103 to 100 is a really key level. If Apple loses that, it is going to be lights out to 95. And I could give you levels that you wouldn't even imagine are possible with Apple, but I assure you they are. So that's going to be a big struggle. I do think that area will hold, at least the first time around. So Apple is a very concerning chart. It looks a lot like the S&P, except it's weaker, and it could start to lead because it's like the biggest component of the Qs. It's big in the S&P. It's everywhere. And a ton of funds are loaded up on this, and it could be a problem. I wouldn't be surprised if early next week you do see a pop in Apple. If there's a allocation, funds may allocate some money. If they don't, that will be very telling. It's looking, though, to me like a big rounded top. It's making lower lows and lower highs, and it's just it's really troubling. I think the best thing, believe it or not, that could happen to Apple is that you get some kind of puke panic before the quarter, and it just dumps hard, and then it sets up for a long. If they rally it ahead of the quarter, it's your guess is as good as mine, but I would be very cautious. So that's the story with Apple. I'm going to go over that chart a little bit more in the weekend review. So that was Amazon. Shake Shack. So that has been a bit of a problem. There's been a lot of supposed insider selling. Anything below 41 is a little bit vulnerable. I think it's just kind of consolidating around this range. The big problem is that there's not that much reference support down here between below 30. 38s, 39s, 37s. If it starts really breaking there and it's below 41, the risk is that it gets cut to 26. That was the IPO price. It's still above there a lot, and I think that's been the fear. I don't necessarily know if that happens, but the valuation is rich in there, and I'd love to hear what their story is with the lockups and the insider selling, if they're going to kind of just chill out. That's the story with Shack. So someone someone asked about IWM and SPY. Let me come back. I'm going to end on those. Square has been tattooed at 12, 13 bucks. It looks like it's trying to rally here a little bit. What you really need to see with Square is to take out the IPO day high of 1478. The ideal situation would be you get up there, back off a bit, and then take it again. That would be a setup for a long. It seems to have a lot of support at 12. If you want to play long against that, I guess so. I don't necessarily know that it was so smart that they brought that public with Twitter having so many problems, but I guess that IPO was considered successful, and it's not in puke mode, so it's, I guess, okay if you want to be long against 12 bucks. Walmart, the reason Walmart, I believe, has been suffering is because of their online isn't competing. They're not as competitive with Amazon, and I think Amazon is able to compete with price. I think the Walmart shopping experience maybe isn't as good as they used to. You go on any of these, YouTube, you could see all these tons of fights with trashy people in the aisles of Walmart. I think that people want to be aspirational, and their goal isn't to shop at Walmart. They also raised the minimum wage. That has obviously been a big drag on margins. You know, the Obamacare requirements have probably been hurting them as well. I think it's just that they're not as competitive. If we do have a recession, by the way, yeah, Amazon Prime, exactly. These things have all hurt Walmart. But the truth is if you look at the technicals, it's stalled out at the 1.618 Fibonacci extension, and it's just been dumping since. So a lot of it is just technical. Walmart has let me take a look at these stats on Walmart here. One sec. Walmart has a 3.2% yield, and the PE is about 13. You probably aren't going to get yourself killed buying Walmart or owning Walmart here. I actually did nibble a little bit recently. Not a lot, just a little bit. But all you need is a little bit. Yes, I cater to the 1% of the people who get my movie and musical joke references. It's starting to look like it's trying to break out of consolidation, starting to make some higher lows, higher highs. I do think it could get back into the mid-60s. Couple of, it had that big dump bar that really kind of got going from like 66s. There's a gap fill up higher around 71, 72. So, I mean, yeah, you could probably see that high, but I don't necessarily know that you really want to be you want to be chasing Walmart. I think you could probably nibble a little bit to play by the dips. Yeah, if you get down moves, you could sell some puts if you want to start building a position. I think that could see some brighter days. If we do get a recession, Walmart will do very well. That's the kind of stock that does well. I'm going to skip TLT for a minute because that's going to be on my wrap up. Lockheed Martin. So they are doing really well. We know the Saudis are involved in a war with Yemen. The world is blowing up. We know that everyone is reluctant to put boots on the ground, and that we're big into fighting air wars. So, yeah, they're doing well. They got a big, $5 billion plus contract today, and the stock didn't do well. Probably also a victim of its own success with lock-in ahead of the end of the year. However, it's not confirmed, but it is forming a bit of a head and shoulders. I'm going to show this in the weekend review video. The neckline that I estimate is around 211.85, so if you start losing that area, GTFO. For those of you who don't know what that means, it means get the F out, and you can insert the expletive. That breakdown will probably be buyable for a bounce for a retest of the neckline, but I do believe that you'd be able to play it short there, maybe for a test down to the 200-day MA, wherever it was. It's currently around 204, but it will be much higher by the time we get there. So just be a little bit careful with Lockheed Martin with regard to that. So that is the Lockheed. The dollar, I covered already. Wynn. So Steve Wynn kind of called his shot. He bought down into the lower to the upper 50s, and the stock has been kind of holding and consolidating around the lower end of the channel. It's still in a bit of a downtrend, but if it can break out of the range of 71.27 to 73. Then I think it can probably rally to the upper part of the channel and maybe make it even up to 90 or 100, believe it or not, as crazy as that sounds. So I would, if you want to start buying, just draw a trend line and try to buy on lows. I guess it's okay as long as it's over the 66.72-ish area. But I think you could nibble a little bit and win. They're subject to a lot of China. But I think that, famous last words, right? But I think maybe the worst of it is in for Wynn. It did bottom around 50. I would say if you want to be long, maybe sell some puts small as a proxy on down moves. Chipotle. So we all know the troubles Chipotle has been having with their poopy burritos, right? They have the E. coli problems. Below 532 and 515 is vulnerable. The stock has come down considerably. The good news is that there is some reference support just below us. We have a reference low at 472.41. We're getting pretty close. The better one, the old top, was 442.40. So if we could get plunged down to there You also have a 61.8 of the entire move around 434.29. So I think somewhere between 434.29 and 442.40 would be a good area to sell some out of the money puts, particularly if it's in a spiky move and the IV is jacked, near dated. So I like playing put ratios for a move down there, and I also like playing if you want to do right or right out down there. So playing for the lower and then also playing for the rebound. So that's what I think about with that. Let's get into the wrap up here with regard to the indices. So SPY here is, we closed weak today. The bad news is we closed below some key levels. We got up into some resistance. We couldn't close over 207.84. We lost 206.76. And today we lost 204.12. The bad news is if we stay below 204.12, the levels that become really important are the 201.90 and then in the 199s. And I had discussed this on the show today, that you basically have a double, almost a triple bottom down at you have 199.95, 199.83, and then the higher low was 200.09. If you lose those lows, those kind of double bottom, triple bottom lows, there is going to be, in my view, a waterfall cascade lower, quite epically. And I think we'll see that low of the 197.86 and potentially the gap fill down to 195. So that, believe it or not, could happen a lot quicker than you think. So just be careful with that. The expected SPY move for next week isn't, I don't think, overly dramatic. It's actually not so... it's about $4. They're expecting $4 and just below 15 cents. So be a little bit careful. That would take you down to those 199. That would basically take you down to there. But I think that the IV acceleration would make that number go higher. And just a rally, if the move is up, if there's, some buying, would basically take you back to some of the old resistance. That, like I said, anything below that 206.76 to 207 to me remains vulnerable. And I really, believe it or not, believe the market is still vulnerable as long as it's below the 210 and 211. 210 has been a very, very important, it was a very prominent pin a few expirations back. There's a lot of volume up there now. And I'm just looking at my chart, and the big, volume node is up there at 210. So really anything below there, to me, the market is still really a little bit vulnerable, and the fact that it's losing some of the really key levels here is just not good. I think next week is going to be a big tell. The last couple of years, I think January has been weak. The first couple of weeks, at least the first week or so, has been weak. I would expect a lot of risk in terms of selling in some of those big names, the FANG names, like I said, and if that happens, it could get a little slippery. Like I said, the savior for that would be is if oil can get you bounced. Those stocks would be really good to keep the market up, the Exxons, the Chevrons. Oil did close today above 37, just barely. I've been saying that I think it's trying to bottom somewhere like 32, 33 to 37 area. So far that has worked, but you really need to see it hold 37 or, it could get squirrely again. Let's talk about IWM. So IWM has had a lot of relative weakness. We are below the consolidation range here, which was really, my box ended around 114s. That is not good that we're below there. I've been saying for a while, anything below 120.58, broadcasting, I just had to get rid of it. Someone can just type in the box if you could still hear me. Anyway, so anything below 120.58 and 117.37 remains vulnerable in my view. And there is a gap to fill. We're getting a little bit close here. The gap fill there would be 110.63. I think you can play that with put ratios if you want to play for a move below there. Like if you want to buy those and then sell 2 times out of the money around like the 107 strike, I think that would work well. Near dated, of course, always near dated. But yeah, below the 50, I mean, the IWM looks quite vulnerable to me. We'll have to see, like I said, how that plays out. The line in the sand here that I'm seeing is 111.50 111.90, like 112, let's say between 112 and 111.44. If you get below there, it's real iffy to me. Qs. So Q has been what has been holding the market up, and I am very nervous that if you see some big rollovers in like stocks like the Apples, the Amazons, the Netflix, the Googles, you could get a pretty substantial pullback. I drew a Fibonacci from the pullback low to the rally to the quote-unquote a new high. It was really a double top. The 61.8 of that move and also kind of the edge of a volume distribution is in the 105s. So I would like playing put ratios for a move down to there, and I also would like selling near-dated puts if we get there fast, or a right or right out long somewhere between 104 and 105 for a right or right out play for a long for a bounce. So, but it is looking, we are consolidating up here. I'm curious to see how, like everyone, how this plays out. If we can resolve higher and get above the 115.75, I think we will get the blow off top in the market. I'm not convinced 100% yet that we have to crash, in 2016. I know a lot of people are really worried about that. It's one option. It is a big opportunity to happen. But it is also possible that we resolve higher and get the blow off top. The S&P is still basically in an uptrend. It's in a sideways to uptrend. It's not really rolled over yet. Like I've said, we've seen a lot of consolidation and a lot of correction and a lot of big names. And if they start getting money flowing back into them, that could buoy the market. I mean, it doesn't only have to be because these stocks did terribly in 2015. There might be a reallocation into those names, and we could get a rally and go back higher. But like I said, for that to really be on the table, we got to start getting over to the 210. It's just that simple. So that's my story. I'm sticking to it. I hope you guys have a great new year. Be safe. It's a scary year with all the terror threats and stuff. Just keep your wits about you. That's what my mom would say to me. Keep your wits about you. So I'm saying that to you guys. Stay tuned on Sunday. I'm going to do a more extensive wrap up, and I'll go over the technicals. If you're not following me on Twitter, my handle is @JustinPulitzer. Be sure to subscribe to my YouTube channel. That's Justin Pulitzer Trades. I post, and if you came into this late or you want to see it again, I'm going to post the rebroadcast of that now. It should be up soon, as however long it takes to upload. Anyhow, have a good New Year's, and I'll see you on the flip side of 2016.